I still think we're in the roaring 2020s. He caved into 25 basis points. I think what this does is it increases the chances of a meltdown. The economy is going to continue to befuddle the pessimists and remain strong.
I'm pleased to welcome back Edward Yardeni, president of Yardeni Research. Dr. Ed's been calling for the bull market to happen this year and throughout this decade, actually. He's been calling this the return of the golden 20s, soaring 20s, rather. And he's been correct so far. We'll get his updated outlook on the markets and the economy and what's next for Fed policy with our interview today. Thank you very much for joining us, Dr. Ed.
Thank you.
Pleasure to have you. You were on the show a couple of times throughout the last year. Exactly 1 year ago, I had you on the show in June 2024, and you were calling for the S&P to reach 8,000 points by the end of this decade, sometime this decade.
I'm still bullish. I think it's a bull market. So instead of tweaking my year-end forecast, I'll start focusing on next year's forecast, which is 6,000 on the S&P 500 and 6,500 for 2026. Then by the end of the decade, I think we're going to see something around 8,000. So these are all sort of my base case, 60% most likely roaring 2020 scenario.
People are calling you crazy in the comments section. Well, it's the S&P is up 1,000 points since that particular interview, so not so crazy anymore. We're at 6,600 points. So I'm wondering if you're updating that forecast, actually.
Yeah, David, I've actually gotten crazier. I'm not talking about 10,000 or more by the end of the decade, and the end of the decade is by the end of 2029. Yeah, I still think we're in the roaring 2020s, and now I'm talking about the roaring 2030s. So if I was crazy a year ago, I guess I'm crazier now.
What has changed? What has made you even more bullish, or actually at least just updated your forecast?
Yeah, well, I watched the economy, and I think over the past 3 years, we've had the most widely anticipated recession of all times that had never occurred. Maybe it's still ahead of us. But I learned from what I see, and what I see is that the economy is remarkably resilient. We've had rolling recessions. Housing is in a recession. Office buildings is in a recession. But overall, the consumer is still spending. I've been pointing out that the baby boomers are retiring with $80 trillion of net worth, and they're spending it. They're passing some of that along to their kids before they pass away. And of course, the capital spending has been remarkably strong, where more than 50% of capital spending now is technology. And here we just had a stress test of the economy with tariffs. And yet the economy is growing at a 3% annual rate during the third quarter, after it grew about the same rate in the second quarter. So I think the economy is going to continue to befuddle the pessimists and remain strong. And I think productivity is making a big comeback, which is it's fairy dust. Productivity makes everything better. It makes real GDP grow faster. It's great for keeping a lid on inflation. It's a booster for wages adjusted for prices. And of course, it's great for profits and profit margins. And one of the amazing things of late has been how strong profit margins have remained, notwithstanding all the tariff turmoil.
Your view certainly is what is reflected rather in the markets, but it somewhat is divergent from what the Federal Reserve itself is thinking about the economy right now. Take a listen to what Fed Chair Powell had to say at the FOMC meeting this week. This is his remarks on the labor market. Take a listen. We'll react together.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our policy.
Revisions indicate the labor market is cooling off. Can you assess that?
Well, it's absolutely correct. The numbers have cooled off, certainly over the past few months, and then there's this big downward revision of 900,000 that's going to be reflected in the final numbers that will be released earlier next year. But that's exactly my point: is if real GDP is growing 3%. And the growth rate of the labor force is now, let's say, 1% or 1.5%, then we're talking about 2 to 2.5% contribution to growth from productivity. That's really the roaring 2020s concept, is that we have a shortage of labor, particularly skilled labor, and companies are going to respond to that by using technology to augment the productivity of workers. Powell, in a different part of his press conference, remarked that we had a very curious situation in the labor market, and what he's referring to is that he thinks, and I think, that a lot of the issues in the labor market can't really be solved with easier monetary policy, because they have to do with the supply of labor. We've had a tremendous reversal in the foreign-born population and labor force. The foreign-born population is down 1.5 million just since March of this year. From March to August, that's the kind of drop, and so that reflects the stop of the inflow of people coming from over the border in the south, and at the same time, a tremendous increase in deportations, and employers that might have thought of hiring undocumented workers aren't going to be doing that clearly, so they're not going to take that risk. And then we've got the kids coming out of colleges wondering, after they studied software programming, coding, why can't they get a job? Well, I think a lot of companies are looking at AI and trying to assess whether this might be a good way to deal with the labor shortage and not hire at this time. But none of these things can be fixed with lower interest rates. But the increase in productivity will allow the economy to grow faster, notwithstanding the slowdown in the supply of labor. And again, Powell is fully aware of these things. I just think that the political pressure, the attempts to maintain some semblance of a consensus on the committee, he caved into 25 basis points. I think what this does is it increases the chances of a melt-up. The big risk to my scenario, I think, the optimistic scenario, is too much of a good thing, kind of 1999, 2000 again. Let's party like it's 1999.
Before we continue with the video, let me tell you about a very important topic: how to protect your privacy. Now, your private information doesn't just live in the inbox of your phone. It's being collected, packaged, and stored and tracked by data broker websites all over the internet, even without you knowing. That's where today's sponsor comes in, Delete Me. I use Delete Me to protect my privacy, and here's how. It helps you. It's a platform that helps you remove your personal data, like your name, address, and contact info from hundreds of these data broker websites. When you sign up, you'll get a detailed privacy report showing where your data was found and what's already been removed. And Delete Me keeps working throughout the year, scanning and clearing your information regularly. It's an easy way to take back control of your digital footprint without trying to track everything down yourself. Go to joindeleteme.com/DavidLin and use the promo code DavidLin at checkout to get 20% off of US plans. Link down below, or scan the QR code to get started today.
The Bank of England is one of the central banks in the past week to have held rates steady. The Bank of Japan is another one. I just reading this report from the CNBC article here. The Bank of England voted to keep interest rates on hold. The Monetary Policy Committee voted 7-2 to keep rates steady. It weighs sticky UK inflation with an uncertain growth outlook in jobs market. That sounds exactly like what Powell was describing. So I'm just wondering how much of this 25 basis point cut that the Federal Reserve did was politically influenced. I'm pretty sure Starmer wasn't pressuring the UK Bank of England to lower rates to the same extent that the government here did.
I think politics did sway the members of the Federal Open Market Committee to lower by 25 basis points. I mean, only a few months ago, maybe even a month ago, they were saying that they are in no rush to lower interest rates because they thought that the economy was in a good place. they do repeat over and over again that they're data dependent, and based on the downward revisions and the weakness in recent payroll numbers, they could certainly justify what they did. But that's just focusing on the labor market data, where so much of the other data suggests the economy is doing just fine. Look, I think the Fed was created back in 1913 with one goal, and that was financial stability. That still is our original mandate. Then somewhere along the line in the 1940s, Congress decided that, oh, well, the Fed should really also manage the economy, and so they should have a dual mandate of keeping maximum employment and stable prices. And all of a sudden, they're finding it's not that easy to do both right now. And I think they need to focus on financial stability and keeping inflation down. I don't think they can do much about the labor market. That could be dealt with fiscal policies, possibly.
In Yardeni Quick Takes, which is a service you offer to retail investors, you cited an article that was published in the Financial Times by yourself, why it might be time to repeal the Fed's dual mandate. This is what you were just talking about right now.
Right.
And importantly, you were talking about how 3% should be the new 2%. Can you elaborate on that?
Well, I'm a practical kind of guy. If they're giving up on getting to 2%, which is the way I read the 25 basis point cut, I mean, for a couple of years, they've been telling us that their number one goal is to get down to 2% inflation, and now it's at 3%. They say, it's good enough. The labor market has some issues, so we got to help the labor market. So on a de facto basis, they're basically learning to live with 3%. Remember when for years they couldn't get inflation up to 2%, and they tried zero interest rates, QE2, and all those things. I don't think that it's a symmetrical situation. If they are concerned that we're 3% and not 2%, they should be raising interest rates, or at least they should be keeping them restrictive. I think one of my arguments with the Fed consensus is they think that the so-called neutral rate is 3%. So from their point of view, they're still 100 basis point restrictive. And I look at the economy, I said, I think the neutral rate is kind of where we are, 4.5%, with a bond yield around 4.25%, 4.5%. Why? Because we got full employment, maximum employment, 4.3%, and inflation isn't quite down to 2%. So we're kind of there. And that's not particularly restrictive when you look at a record high in the stock market, gold, Bitcoin, and other financial assets.
Okay, so if, let's say, the Fed does lower, are you concerned about higher inflation then? And by the way, the 3% renewed or new target, are you implying, or at least assuming, Dr. Ed, that inflation will be higher and persistent for longer embedded in our economy?
Well, right now, I think Fed officials have this notion that some of the recent inflation is tariff related, and that this too shall pass and we'll get back down to 2%. I sort of agree with that, but not quite. I think that the tariffs didn't increase tariffs. They just kept the tariffs from falling from they kept the inflation rate from falling from 3% to 2%. So that's the current situation. I think when we look at the inflation news more closely, we see that it's not just durable goods inflation, which is very much affected by tariffs, but we're also seeing that services inflation has kind of gotten stuck around 3 to 4%, and it would be much better if it was down to 2 to 3% to be consistent with the 2% target for the Fed. I'm not arguing that they should change their target. Quite the opposite. I'm arguing that they should really they should continue to have focused on getting inflation down to 2%. But they kind of finagled it a bit by saying, well, the unemployment rate is okay, but we don't want it to go higher, and we're concerned about the payroll numbers. And as your clip said, even Powell was kind of mousy about what this was all about by saying that it was sort of an insurance policy against the economy, the labor market getting worse. Well, how about, so meanwhile, they've basically given up on making the premium payments on their insurance policy to bring inflation down.
Some economists or observers of the market may argue that there's been a divergence between actual economic growth and the stock market. So your own leading economic indicator on Yardeni's website has shown that the leading economic indicator has been trickling down ever since 2023, 2024,
Right.
while the inverse has happened with the stock market. How can you explain this divergence?
Yeah, well, when any data doesn't support my story, David, it's got to be bad data or it's going to be revised. I think the index of leading economic indicators needs to be recalled. It needs to be.
Okay.
I think it should be called Index of Misleading Economic Indicators. It's just been dead wrong all along here. The other chart, which I would have highlighted, would be the Index of Coincident Economic Indicators. All-time record high. It's a monthly indicator of GDP, basically. It's got payroll employment in there. It's got industrial production, personal income, business sales, and that's at an all-time record high. I think that was in August. Yeah, you can flip a little bit more. Yeah, a little bit more. And that's it. See, bingo. So the blue line is the index of coincident economic indicators, all-time record high. And I actually prefer the S&P 500 forward earnings, which is available weekly. And that's actually getting stronger in record high territory, consistent with what we've seen in the first and second quarter. Remarkable strength in earnings, notwithstanding all the tariff turmoil. So economy looks fine to me from a GDP perspective, coincident indicators, earnings perspective. And if the problem is in the labor market, is the supply side problem to a large extent that the Fed can't do much about. And it all means that productivity is coming to the fore here. And there's no reason to lower interest rates if we got strong productivity growth. You don't need to lower rates to boost productivity growth. Instead, that liquidity could go into creating financial instability, which, again, is the Fed's original reason for being.
This is a report from CBS. This week, we're seeing large retail stores, box stores, Home Depot, retailers, Macy's, Nikon, camera maker Nikon, all announcing they're raising prices for some of their goods as tariffs take effect. Now, I wonder if this is a turning point for not just companies, but financial markets as well. One argument is that if these companies do go ahead with raising prices, consumers don't have the capacity to actually absorb these higher prices, sales will slow. We'll start to see either margin decreases and or slower sales in the next quarter. What do you think?
Well, I think it's a valid argument, but everything is there's a lot of moving parts here, and you can always focus on one gear and say it's not functioning quite properly, and then miss the fact that all the other gears are working, and the one that looks like it's malfunctioning isn't all that important to keep the machine going. And that's kind of the situation we're in right now. The economy overall is in fact growing. And so if we do have some challenges ahead for the consumer, there's been lots of reports that 10% of consumers are accounting for 80% of consumption. And I think one point that I've kind of nailed over the past few years is the impact on the baby boomers. And that's because I have an inside track on that. I am a baby boomer, and I'm still working for a living, but a lot of my friends are retiring. And again, the baby boomers are retiring. It's the richest retiring generation of all times. They're sitting on $80 trillion of net worth, and they're not going to leave it all to their kids. I mean, the kids never cleaned up their room. We didn't like their friends, so the hell with them. Let's just spend it all. But of course, that's not what's happening. You can't spend all of that. And meanwhile, as the baby boomers that are retiring, I have friends who are trying to spend it, but they can't spend it because the stock market keeps going up, and so that just paid for the cruise. And I do know from personal experience and friends that there is a lot of intergenerational transfers going on between us and our kids to maybe help with mortgage payments, maybe help with extracurricular activities for the grandchildren. There's a lot of that going on, and I think that's so. Again, you got to put this in a broader context of here's a list of the negatives and the positives driving the consumer. And the reality is, we just saw with retail sales is they're still spending.
Do you think with the Fed pivot now in full motion, we can get a resurgence in home sales activities, especially for first-time buyers now?
Well, we've had a small dip in the mortgage rate, and it was reported as a big percentage increase. But when you actually look at the chart, it's still looks pretty depressed. No, I think the problem is the availability of housing. Baby boomers like myself aren't moving. We may have big houses, but the kids come and visit with the grandchildren. So I think there's a lot of that going on. And then we still have a lot of regulatory issues that make it hard to build homes. I think we just need to build a lot more homes. And I don't know how you do that other than I think the administration is looking into how regulations could be amended to make it easier to build homes more quickly.
So you're bullish on the stock market. What happens to the bond market? What happens to the long end of the curve in a lowering interest rate environment from the Fed while at the same time the economy is growing, and per your projections, the stock market will continue to grow as well?
Well, I think the bond market is basically where it should be. If you look at the bond yields in the years prior to the great financial crisis, guess what? They were right around here between 4 and 5%. And we've seen the economy perform quite well. I mean, it's true that high long-term rates have clobbered downtown office buildings, but so has the impact of the pandemic and people not coming into work. And, the brand new office buildings are doing just fine. So it's not clear that we need lower mortgage rates or bond yields to stimulate some areas that are depressed in the commercial real estate market. As we just discussed, it's not clear that lower interest rates are going to suddenly revive construction of housing. Meanwhile, housing hasn't been that terrible. I mean, there have been worse recessions in housing in terms of troughs than we're seeing right now. So 4.25 to 4.75 on the bond yield. I think we can't dismiss the possibility of a debt crisis. Not something like what Ray Dalio has been warning us about, a total calamity, but something like what we had in 2023, where the bond yield went from 4% to 5% in a matter of a few months. But Janet Yellen, the Treasury Secretary, came up with a clever response to that. She basically told my friends, the bond vigilantes, if you don't like my bonds, I won't issue any additional bonds. And if I need any more additional money, I'll get it in the bill market. And so the bond yield went from 5% right back straight down. And so now Treasury Secretary Bessent, who didn't like what she did at the time, now has completely endorsed it. And he's even said that now that we have stable coins that have to be backed by Treasury bills, that might also help to create a new demand for Treasuries. But I think it would be a good thing, believe it or not, to have a debt crisis at some point that gets the attention of the politicians and makes them realize that they really have to get their act together and slow down the growth rate of outlays and increase the growth rate of revenues. We do need to resolve this issue. Right now, I can only characterize it as generational theft. You young folks, the baby boomers, are ripping you off. That's all there is to say. We're getting all of our social services. The deficit is huge, and you're going to be left with a debt.
But Dr. Ed, it's not like the government hasn't recognized that there's a deficit problem. The Doge was set up to combat this problem. It was later abandoned. I mean, what can be done at this point?
That didn't work.
No.
Yeah.
No. They've tried. They failed. Yeah. What should they do?
Well, there's a lot of simple things that can be done that are very controversial, like lengthening the age. You have to live longer before you can collect Social Security. I get Social Security. I'm still working, so I'm paying taxes on it. But maybe administratively, the baby boomers who are working shouldn't be able to collect, or at least if they're going to collect at a later age. So there's still a lot that can be done to clean up the excesses in the mandatory spending. But the big problem is we now have the legacy of all that excess in $1 trillion worth of interest expense, and that's why the Trump administration has been leaning on the Fed pretty hard to get. I mean, Trump would like to see the Fed funds rate down to 1%, which would be nightmarish in terms of the melt-up scenario it would create in the financial markets.
I have two more questions and I'll let you go. Why I've been getting this a lot in my inbox. People are wondering what to do in a stagflationary environment. I know that's not what you're calling for right now. You're not calling for low growth or no growth at all. But in the event that we do get high inflation and lower growth, what should be done for investors?
Well, I've been doing this for a few years, and in the past I never paid any attention to gold. It doesn't have a coupon. It doesn't have a dividend. I couldn't value it. But when it crossed above 2,000 last year, I said, I think we're starting a bull market again in gold. And when it crossed 3,000, I started putting out some targets, 4,000 by year end, which looked ridiculous at the beginning of the year, but now looks pretty possible. And then if it gets to 4,000, I think 5,000. I base that on central bankers that don't like us, like in China and North Korea and Venezuela buying gold as an alternative to the dollar. But I think gold is a good place to be. I think inflation hedged bonds is a good to be, and I think the stock market. I think we'll continue to, as we discussed at the beginning of our discussion. I think that the stock market has higher to go.
And then finally, you wrote in a note in your Yardeni Research morning briefing, which I encourage people to sign up for. Very good daily information. You said, helped by lower interest rates, many of the S&P 500 industries involved with banking and construction have been standout performers recently. Well, that got me thinking, Dr. Ed, in an environment where we do get lower Fed funds rate, what are the sectors that will continue to stand out and outperform within the S&P?
Well, I really like the financials. We're sort of in the sweet spot for financials where stock market's at a record high and suddenly the IPO market has opened up big time in M&A activity. And guess what? The investment banks are making a lot of money and they're going to report better earnings. And the financials is a big sector in the S&P 500. And if it does well, it gets everybody bullish about the rest of the market. So I think financials look pretty good. In the information technology, I think mid-cap, small and mid-cap information technology, industrials, these are sectors we've been recommending overweighting in the large caps, and we would stick with them. We would continue to focus on the cloud. The cloud is the biggest beneficiary of the AI evolution of the digital revolution. So cloud providers should continue to do very well.
Perfect. Thanks very much. Appreciate your time, Dr. Ed.
Thank you.
Let us know where we can follow you and learn more from your work in the meantime.
Yeah, well, again, if you want a trial of the institutional product, you can find it at Yardeni.com. And then YardeniQuickTakes.com is where you can find the product that's more appropriate for individual investors. It's a daily. And then I am on LinkedIn. I am on YouTube. So it's not that hard to find me if you're looking for me.
All right. Very good. Thank you very much. We'll put the links down below.
Absolutely. Thank you.
So make sure to follow Ed there. And we'll speak to you again soon. Take care for now. Thank you.